is Larry Carrasco from Insmax Insurance Brokerage, and we're thankful to have you on the call today, and we do appreciate your time. We are here to talk about some applications of life insurance that's often overlooked. We have a wonderful partner in North American that has a unique product with multiple applications that generates high early cash value and can also work for those clients that are thinking about allocating funds that are just sitting in dormant assets. Greg, if you move the slide, before we sort of proceed here, I'd like to tell you a little bit about Insmax Insurance Brokerage for some of the new folks on the call. We've been doing this for more than 20 years. As a brokerage general agency, we represent all the major companies and a few you may not have heard of. Our job here is to help you learn about new opportunities, ideas, and certainly products. And we can provide you with all the necessary tools to do so, including product material, helping you with contracting and licensing, doing some pre-underwriting, of course, all the forms. Our job is to make your job easier. And we want to be a company that you certainly do business with from here and for many, many years in the future. So with that, I'd like to introduce our guest speaker today from North American, our Regional Vice President, Steve Zimmerman. Steve, are you on the call?
I am, Larry. Thrilled to be here.
So are we. For you folks who don't know Steve, I certainly have known Steve for many, many years. This is a guy with a ton of energy, a guy who will help us, and in doing so, certainly help you relative to anything North American. He's got a ton of ideas, and today he's going to give us an overview of the use of some smart money with an even smarter insurance product through North American. So, Stevie, take it away.
Hey, thanks, Larry. It's great to be here, and thanks everybody for spending a few minutes of your busy day with us here. We're really excited to share some planning ideas, some sales opportunities, and I think the uniqueness we have here is we have the ability to use an insurance solution with extraordinary high early cash value. And life insurance, for example, it has surrender charges. So a lot of times people like what life insurance does, but they don't like the time it takes to kind of get access to their money. So let's think about smart money. What am I talking about here? People right now, if you think about cash on the sidelines, money market balances, cash in the bank is growing at record rates. I mean, it's not a stretch to say that more people are sitting with cash on the sidelines than ever before. And just think about it. It's common to be more concerned about the return of your principal than the return on your principal. So what we're looking at here is how can we help you straddle the need to do more, get more benefit out of your cash, but still preserve that safety and liquidity. That's kind of why you have it in cash, right? So we're going to go into a couple of places. We're going to talk about probably your retired client that may be 60 plus that's sitting with some cash on the sidelines, and we'll walk you through that. But we'll also take a look at the business market. Businesses are also sitting with a ton of cash for various reasons. And then we'll just kind of walk you through that. So we, with the North American product, we tend to prefer talking about sales concepts. Really don't like talking about product too much. I think that's kind of boring. But why this works so well is it's a pretty unique product design with the high early cash. So Greg, if you could just move to the next couple slides. Awesome, thank you. Hey, so let me kind of put it in perspective. We've got our smartphones. I mean, you probably have yours there, and if I start getting boring, you're going to sneak a little peek on your text to see who just pinged you there. We've got our smart TVs. I've got the remote here. I'm kind of watching the news, and if I get a little bored or get my work done, I might stream a little Netflix. You get it. But what about the next slide, please? If you think about cash, smart money. Now what the heck am I talking about? What I'm talking about here is how do I keep my cash safe and liquid, but still get more benefit out of it? And that's what we're going to walk through. So next slide. We're going to probably look to start with the retired client sitting on a bunch of cash. I mean, right now, the inflation is the silent killer. That these days we probably don't think about that as much. You think about having enough money in retirement. You think about market corrections and volatility. But all you have to do is think about what it cost to fill your Suburban or your Corvette the last time you went out. What did it cost you when you went to the grocery store? You probably paid more for something, or you paid the same and you got less of it. So what we see here is people are sitting on kind of a devastating erosion of purchasing power. So what we're looking at is we've got a way to say we could get more benefit out of those dollars, but we're going to preserve the safety and liquidity. And that's the part, the hurdle that we have a hard time getting over with the typical life policy. Next slide. So think about this in terms of 3 L's. Now I'm thinking about, just give me your mind's eye, 60 plus retired clients. They're sitting there with a bunch of cash on the sidelines, and you know why we talked about it. I'm more concerned about the return of my principal and the safety. I don't want to lose it. I've spent a lot of time growing my money. I've recovered from 2008, but man, I don't know if I have the stomach to do it again. So let's think of in terms of leverage, liquidity, and legacy. This is what we're going to kind of build, our sales idea on for that retired client. Next slide. So first things first, leverage. Now, Mr. Client, Mr. Prospect, what if I had a way for you to get more benefit out of those sidelined, unemployed assets and still keep them safe and liquid? Now, we know, thinking about an IUL policy, we're going to have the benefits of tax-deferred growth. We're going to have downside protection. We're going to have the ability later on to have policy distributions. We can make them either taxable, or if we want to really minimize the charges, we might make it taxed like an annuity. We also have the ability to have accelerated death benefit and then also the leveraged death benefit. So what if we could do all that and we could still keep your money liquid? That's the thing we can't typically do. So from a leverage standpoint, we have the ability to go into having retirement income if you want it. This is a great kind of secondary place to put money. This isn't the place you're going to put the money you're going to use for paying for the pizza on Friday night, but it's kind of a backstop if you run through some of your accounts. An inflation hedge, it's a way where we can actually outpace inflation. We can have participation in various index options where you can have market participation but not have downside risk. So the one question we love to ask is, what if you could position some of your assets in a place where you go up on the days the market goes up, but you never lose a penny on the down days? And then tax deferral, obviously, probably not a stretch to say that I think taxes are probably going up in the future. I mean, that's probably a no-brainer. So I think here, this is what we've got. We've got a tremendous leverage opportunity.
Hey, Steve, this is Larry again. If you don't mind, just a question for you.
Please.
Go back to that last slide, Steve. What
Sure.
you were just describing, and for some of the guys on the call, this looks a lot like what an annuity might look like. In fact, like a fixed index annuity for some guys that utilize those products effectively has everything you just said. It can provide retirement income, it's an inflation hedge, the downside protection, and tax deferral. But what strikes me is that these fixed index annuities right now, the caps and the participation rates have been pushed lower and lower with volatility in the market and low interest rates. I think if I'm not wrong, that we've got some index choices here that have pretty significant opportunities for index credits. Am I right about that?
Yeah, absolutely. Great observation. So I think what we'll see here is we will often run this as a single premium with a minimum face. We'll make it a modified endowment design, which just means taxed like an annuity. So you're going to have many of the characteristics like an annuity, like you just said, but there are significant additional benefits you wouldn't have with an annuity. In this type of design, you're going to have typically a little higher cap. We have index options where you'll have better opportunities for upside growth with those caps. The other thing is you'll have a significant death benefit on here. So from living benefits perspective, you can accelerate some of your death benefit, and whether it's a MEC or not, that accelerated death benefit is not taxable. So you can have a critical illness for cancer, strokes, and heart attacks acceleration. You can have a chronic illness acceleration, and it's based on the death benefit, not the cash value. So it really is, it does what an annuity does, but actually gives you a lot more. And that's why we're seeing this becoming really increasingly popular, especially with annuity producers.
Excellent, excellent. Sorry to interrupt there, but it just hit me right in the face, and I wanted everybody to sort of hopefully pick up on that. So go right ahead.
Yeah. No, hey, please continue and jump in anytime you guys want. I think the only other thing I would say is with the high early cash value, your annuities typically don't have that much early liquidity as well. So this isn't necessarily taking the annuity premium to here. It's a way for someone that sells annuities to kind of go deeper in to get at more of the client's assets and deploy those into a plan that might otherwise be outside your reach. So hey, let's take a look at liquidity. The second thing is that, it's what we've been talking about, but, a significant benefit of this design and this product is the ability to get money while you're alive. I mean, that's really, isn't that what we're doing? I mean, I like life insurance. I got my kids and grandkids. Gosh, I love them, and I'd like them to have my money, someday, but not till I'm done with it. So, the thing we have here is the living benefits, a lot of you would probably agree, is really the appeal for many of the reasons why people think putting money into life insurance these days. So the first thing, waiver of surrender charge. We'll show you an example of this momentarily, but this product in itself has extremely high cash value because there's no premium loads. So this is either a low load or a no load product. I probably wouldn't use the term no load because that has a connotation in a different context, but there's a waiver of surrender charge rider that says if I put this on, you will have 100% cash value equal to surrender value in year one. If you don't choose to use that option, you still have probably 90 to 95% surrender value to cash even in the first year. So you can use this as supplemental income. And as I indicated, I probably see this as maybe your second tier. This is maybe that account that you might use and set aside for your contingency planning, maybe when you're 75, 80 years old. If my portfolio of my securities, does great, I may not need this. I may just pass the money on to my kids. But what if I spend more than I had planned? What if my securities account doesn't last as well as I think? This is a great secondary place to have income. And then the accelerated death benefit, this really is also a way that you can have access for that critical, chronic, and terminal. The nice thing I like about this is, the Swiss Army knife term is something, the metaphor, it's something we use all the time, in the business. But, this is a way that you can have the ability to pivot and go down the path for either cash values, accelerated death benefit. If you don't need them, you can, deploy the assets in the death benefit. The nice thing is on the front end, you don't have to pick what path you go down. And if you don't want to go down any of them, you can just let the death benefit ride, and there's no cost until you accelerate any of these options. So, next slide, please. Hey, and last thing, at its core, it's a life policy. So if I don't need accelerated death benefit, if I don't need accelerated or a cash value for my income needs, the death benefit will pass. Income tax free. Right now we've got a pretty high estate tax exemption. Who the heck knows what's going to happen there in the future? But right now, the majority of our clients that are buying this, they don't have to put it into a trust. They don't have to worry about it. So it's going to pass to the kids income tax free. It will generally, it will bypass probate. So we've got a really clean transaction there. So, we've got a really flexible way to get more out of these assets, get them off the sidelines. And, if you change your mind and say, you know what, I kind of made a mistake. It's almost like if any of you have ever sold Lincoln Money Guard. I got $100,000 in Bank of America. Let's move it over here. Oh, I changed my mind. Give me my money back. No sweat. We can do that too, but frankly, we don't see anybody surrendering these because once they get into them, they kind of like them. So, let me pause for a second. Greg, Larry, any comments? I unpacked a whole lot there.
Well, what's interesting about what you were saying previously, and for those of you who haven't seen products from North America, the chronic and critical illness benefits are often baked into a few carriers that we do business with. But the one thing about North American, even on its term, which is a separate product here, is that you've got competitively priced products that have these additional bennies that come in. And we're all talking about chronic illness benefits. But interestingly, everybody on the call here can raise your hand, and not one, if not two or three people that have had a heart attack, stroke, or cancer. With that said, this product has the ability to access part of that death benefit for that very emergency. It's a really neat thing. I'm going to use a term that I've used in my office for folks. It's kind of like going through the drive-through and you just order a burger. And then they say, hey, would you like a combo with that? Just cost a few dollars more, a few cents more, excuse me. And what you get is you get fries and a shake. Well, that's kind of what you get here sometimes when we're dealing with this particular product and other products from North America. You get the ability to deal with different risks. Yet, if your primary reason was coming in here for liquidity, well, it's hard to beat this option. It could be a long-term duration, short-term duration. We're going to talk about an example or two here where these things hit. But when we were discussing annuities just a minute ago, Steve, the probate thing is a big deal, which is similar, but income tax free on the entire death benefit, which you can't get with annuities. That's a big, big deal. And that's about all I have to say relative to that. I mean, you've got the liquidity. We talked about the leverage, and for those folks that just have money sitting on the sidelines, the just in case money, just in case it gets sick, just in case, I want it to go to my kids or grandkids or a family member. You've got something here. So that's kind of my comments there, Steve. You did unpack a lot, but at its core, folks, we're talking about a product where if you desire, you can click a rider on there and you have 100% cash surrender value. And if you don't elect the rider, or your cash surrender value is going to be in the 90% or better. And we just want to run some of the illies for you here. So, hey, Steve, why don't we move on to the next slide and talk about a case study?
Okay, perfect. Hey, thanks. Hey, what I'd like to do is give you one example, and then if you do have specifics, what I'd recommend is as we're going through this, if you think of clients or prospects, just jot their names down. So maybe when we're done, you've got 2 or 3 names of people on your desk there, and maybe give Greg and Larry a call, and or my internal Troy and I are available. You can just think of us as an extension of the INSMAX team. So let me give you one example. Say we've got a client. He's 60 years old. He's sitting with $400,000 in cash. It's like, I love the examples. It's like, is it your live on money or your leave on money? Is it your now, later, or never money? So we could be talking about this as kind of my never money that I'm not going to need, and then I'm thinking it's for my kids, but you know what? I'm not quite ready to give it to them. I might want it, and I don't really want them to buy a Corvette just yet. So let's take a look at this. Greg, if you could just go to the next slide, but actually there's 3 builds in it. If you could go and just click 3 times more, we'll just expand those columns. Perfect, thank you. What I just wanted you guys to see here, and I broke my first rule, is because I never like using illustrations in a setting like this. Like you're squinting at the screen, like I know the numbers, and I'm even squinting at the screen. What I wanted you guys to see here is it's a male age 60, $250,000 single premium, and we're running a minimum mech design. So what and I'm going to give you this in concept, or we can send you a sample illustration, or we can run one for you. What the gist of what we're doing here is, this was the client. It's my never money, $250,000, solving for with single premium, minimum mech face. It's going to be taxed like an annuity. So what we did here was I ran preferred, one off our best class. It comes up with $579,000 death benefit out of the gates. That means $579 is available for your accelerated death benefit. If you look at the guaranteed numbers, you see there the guaranteed cash surrender value at the end of year 1 is $200,009. So this is where I can say, I can reposition your cash. If you want your money back, hey, you can get it all back. And then you see the non-guaranteed values are even higher. This was run with the waiver of surrender charge rider. If you run it without the waiver rider, you'll probably have here maybe 240, 243 cash value versus 250 surrender value. But then the other thing is the consumer values or the cash values are usually better after only about 3 years. So if you have one of these, what I'd recommend is let's run one with the waiver rider and run one without the waiver rider. People, conceptually they like waiver of surrender charge, but at the same time, when I see that my cash values are actually better, and usually in about year 4, 3/4 of the time when we do case design, clients, they choose to do it without the rider, without the waiver rider. So the other point I just want to make, and then we'll kind of get on to some other, other places where this concept can work, is you see, in a policy like this, it's an indexed universal life. There's 2 moving parts, 2 variables in a universal life. Number 1 is the insurance charges, and number 1 is the crediting. So North American, I can tell you, we're a privately owned company. We're incredibly stable. We've never gone back, and we've never increased enforced cost of insurance charges. Does that mean I can guarantee we never will? Well, heck no, nobody can. But I can tell you the company's in really strong, in a strong position right now. I can say that it's really pretty solid the way it is. So current charges is a good benchmark for your worst case on charges. But then if you look at the middle column, non-guaranteed charges, minimum account value 2.5%. This product has a minimum 2.5% annual account credit. So if you've got money that's sitting on the sidelines, I bet you they're not getting 2.5%. So we can dig into some of the details there. So we not only have upside potential, we have downside protection, but you got 2.5% minimum account value per year. So that's a pretty cool thing. Next slide, please. So I'm just going to kind of finish this out and let's then pivot back. Guys, maybe we can walk through some other areas where we're seeing sales. But, the bottom line, leverage, liquidity, legacy, it's the 3 Ls. That's how we position this to clients. Next slide. So then, for your clients, obviously you see here, less stress, more benefit out of their monies. For you guys, the producers, I think this is a phenomenal way to go deeper with your clients. I also honestly think this is a really powerful prospecting tool. I mean, it's a wonderful way to call new folks and just ask them about cash. It's a great way to talk to business owners and ask them if they're sitting on cash. And you got a heck of a story. So why don't we go to the next slide, guys? And I think we got some ideas we want to walk through here too.
I was approached by an advisor recently about using this with business owner clients. There's a product term out there called corporate-owned life insurance. You may or may not have heard about it. And generally, that just means that businesses own life insurance. Well, sometimes this corporate-owned life insurance, it comes in the form of really, really high cash surrender value. So I said, wait a second, let's try to get this because it's not necessarily always available, in smaller denominations at times. But let's just take a look at business planning here. So, retained earnings and bank accounts. Let me tell you something, folks. A lot of companies run businesses and they keep, a quarter, sometimes 6 months worth of operating capital just sitting in a bank account at a bank just because of potential cash flow crunches. That money could be put to work using something like this. And if there's a liquidity event, they can cancel that contract and get their money back. I mean, it's basically it's a better way of allocating their funds. I was talking with a property and casualty advisor of mine who does commercial insurance, and he said, this thing really could be used as an alternative to cash that needs to be posted for a construction bond. So think of your construction companies out there, your larger ones that might have to post, $500,000, $250,000, $1 million in conjunction with a government project that requires bond. Even key person insurance, I talked about, reallocating these retained earnings. So a lot of companies will buy term insurance, so to speak, on their key guys. Well, I call this the highly funded term alternative. This is a chance where you could, acquire insurance on somebody if you're going to keep the cash sitting in the bank. And if we're actually earning money on the deposit inside the policy, and we're also providing a death benefit that benefits the business and also the employee, again, we're coming at this getting 2 to 3 benefits with one allocation. And then finally, you can use it as a tool. You could say to a key guy, listen, we're going to put this policy on you. We're going to put whatever it is, 100,000, 20,000, 80,000, 200,000 in a contract. You can see it. Here's the cash. After a certain amount of years, we're going to bonus this thing to you because we think you're valuable, but you got to stick around. And it's a way of retaining these key people. So just some ideas to think about for a second. And then, there's different ways you guys can get compensated too. We didn't really talk about comp. So traditionally, we're able to just pay, heap commission with universal or term life insurance. Well, North Americans come up with a couple of cool options here. One, you can get your normal comp, get it all up front like we typically would do. That's option A. Option B, there's a little bit less compensation, but you also get a trail. So for those folks that are doing, some wealth management money, getting compensated on the performance of the cash surrender value is kind of normal for your accounts. And in option C, if you're really willing to go back and walk away from some of the front side comp, just take it as a trail. The compensation is pretty handsome. We could talk about that amount, but I could show you an example. And the example here is for $1 million single premium, which coincidentally happens to be the maximum that North American will accept on one policy. So if we had $1 million case here, and the target premium, as you can see by the blue arrow, is 15,700, one time. Well, commission option A, you can see in the first set of columns, would pay 38,738. If you did commission option B, you're making more than that because there's a trail, and the trail compensation would pay you 43,000 overall. But the levelized commission would pay you less up front. But you can see by year 3, you're actually you've made more than what you would have made in commission option B or A. And then to the extent that the policy stays on the books, the compensation can be quite remarkable. Now, comp isn't what we're dealing with here, but you do get paid, to do this business. So you have the option. And what's interesting about it is these commission options don't impact the performance of the policy one little bit. It really just depends on how you want to be paid. And North American's great enough to be able to do that for us. So with that, Steve, why don't we talk a little bit about just some of the technology, and then we'll wrap up the meeting. Go right ahead, Steve.
Okay. Hey, great. Thanks, Larry. Great points. Hey, the getting cases through is one of the things we're really focused on these days, and leveraging technology to make your life easier is clearly a priority. We have a fully digital from start to finish process, which we're getting great feedback on. The process is called Right Away. It's an accelerated non-fluid underwriting platform. So, boy, that's a mouthful, but let me say what it really means to you. It means for clients up to age 50 and death benefit up to death benefit to 2 million, age of 50 to 2 million. If you submit a case either through Simple Submit is our e-app or a paper application, it goes into the Right Away process. The Right Away process scans through a LexisNexis data search, and if your LexisNexis score is high enough, you will skip the exam and fluids. Right now, we're seeing between 50 and 60% of the cases skip exam and fluids out the door in a few days. If you don't accelerate and skip the exam and fluids, you go back to the traditional process and you do the regular exam and fluids, and you can still get best class, so you're not harmed in any way. So it's up to 2 million to age 50. It's up to 500,000 to age 60. So a lot of the clients we have in this context may apply. So we're getting great feedback that in a time when companies are struggling, we're getting stuff out the door pretty darn quickly. So why don't we just kind of talk about next steps, guys?
Certainly. So hey, next steps really, guys, is number one, they've got non-password protected information right here. If you go to NorthAmericanCompany.com/marketing toolkit, there's so much material there. You won't have enough time in a day or maybe even a week to go through it, but it's really, really good. And they even have support pieces for different situations, whether it's business or personal planning. So I encourage you to go there. The next step is, hey, we've been sort of running through this for the last 25, 30 minutes. Is there anybody pop in your head? Just write them down on a piece of paper and then call us. We're basically here to help. And as you guys know, we'll go as far as we need to go to help you win this sale. I don't care how many designs we have to do, what it takes underwriting wise. You can reach out to Greg, me, or Sean. Our phone number and extension and emails there. And we're here basically as an extension of your office. And we really want to help. And we do thank you for your time today.